So with a mutual fund trust, you can diversify out to different types of accounts. If you're using a closed accredited only account that's for cash, you don't have the same ability to offer it to as many people. So if you want to be able to invest from your TFSA or your RSP or your RIF, you have to use a mutual fund trust structure to be able to offer a wide offering like that. Sure. Well, we feel it's really important to have a proper exit strategy. I think anybody in development and real estate understands an exit strategy is monetarily, it's just hugely important for the investor. It's paramount. So we know that it's not realistic to think that we shouldn't profit at different stages and that we should be completely transparent to our investors. So when we look at exiting, we look at it from what point in time are we at in the development? Can we take it to the full end, which is, of course, our goal is to build every home, turn the keys over to new owners, and take the highest amount of profit we can in conjunction with our investors, of course. But if an opportunity comes along where after what we call post-site plan approval, which is common, after we have our site plan approval, if an opportunity comes along and we can profit from that at a reasonable amount, and we think that it's a better way to de-risk our investment at that time, we'd absolutely do that. So we incorporate different scenarios in each property that we acquire to know that where could we exit if we had to? If we had to get off the off-ramp, where could we do that? Our intent, again, just to reiterate, our intent is to carry every investment to the end because that's why we picked the property in the first place. No, we won't swap properties. Okay. We feel that's another important alignment with investors. If you're investing with me and with my projects, you should know that my focus is on what I brought to the table. So if I've identified a property that I say I can take this to the end for the reasons that I've put forward and trust me, invest in this project with me, I should not be allowed to swap that property out for something else. Okay. Because fundamentally, it's if I exit that property and we profit from it, you should be getting your capital back. And I should have to prove to you again, if I want your money back into another project, I should have to prove to you that, hey, here's reasons why you should give me into my next investment opportunity. It shouldn't just be a rollover. Hey, I've given you money, I've made you money, now you can just keep going with me and keep investing and no worries. It should never be like that. So we think that it's important that we only hold the investments in the fund for the time that we need to. When we exit those, capital goes back to the investors. Capital goes back to the investors first, and then the profits to everybody. Yeah, absolutely. And the biggest thing to remember is that we have a hard stop on our 12 months. So we've imposed these goalposts on ourselves. And with that, we also have a hard stop on the number of projects that we'll bring into the fund. So we have it at 5 to 7. So this is not an and/or situation. This is an or situation. If we get to the 7 properties before 12 months, we would stop. And that allows us to value our units at the same value all the way through. What it does is it creates diversification for the investors because we're picking up to 7 properties that have the same profile. And we're de-risking each investor a little bit by having a diversification into other projects that have the same pro forma profile, same geographical profile, and allows us to hold that unit value. So each unit is going to be valued at $10 until the time that we close the fund, which you anticipate to be 12 months. But if we get to our 5 to 7 properties and we're satisfied, we'll stop and we'll close the fund there. So I think it's important to note that the diversification happens automatically as we stack in the capital. As investors put their capital in, we automatically move that capital to the properties. And we already have 4 properties to move into this fund. I think the second thing that's very important is to know that we move the properties in at cost. So we're not taking a lift on these properties. There's a certain amount of cost to acquire the property and a little bit of soft costs that we would go through to do some engineering or some environmental or some due diligence on the property. And that's how we move the property in. So even if the property has increased in value from the time that we've locked it down or from the time that we've acquired it, we're moving it into the fund at that cost. So each investor gets that bump by there. So we don't need to revalue the units until we start to have a material change in the values of the properties, which would mean we're starting to sell. We're starting to sell off parts of the property or all of the property or houses, units. Well, that's a big thing for us. We feel that we're de-risking the portfolio by a tremendous amount. The first lift in real estate development comes from the time that you speculate on a property to the time that you've got a site plan that municipality is going to accept. And there's lots of various stages of site plan approval and draft plan approval. But once you get to the point where the municipality and the planners in that municipality are on board and giving you direction that fits their master plan, you get a jump in value. So when we acquire a property, for $1 million and we get site plan approval, and we can now go back and appraise that property at the much higher value, which could be 2 or 3 times the value. So by having our 4 properties already aligned, having them in the site plan approval process and near site plan approval, in some cases we have draft plan approval, we've already added accretive value to those properties before we've even put them into the fund. And as I mentioned in a previous answer, that we're moving them in at the cost that we acquired, not at the increased value. Huge advantage to investors. Yeah, so we want to diversify properties in different ways. We want to have an approach that complements in diversification. So we're not just trying to develop properties that are for a single market. We know that we're in areas like Georgian Huron and along lake shores where we've got a lot of job generation, but we also have a lot of migration of people that are moving from the 401 GTA corridor coming into the Kitchener-Waterloo-Guelph area. We haven't forgotten about that area. We have properties in that area as well, but we see this leapfrog effect happening where people are starting to move all the way to the lake. So you've got 2 factors. You've got job generation and you've got migration. So you need to diversify not just in the geography of your project, but in the type of builds that you're doing. Whether you have townhouses, row townhouses, condos, single family homes. I think that's probably the most of the gamut that we would have. But we also have some properties that are on green space versus on waterfront. So giving people a choice. And our job, of course, is not just to find the property and build the homes. We have to sell these homes. And if you don't offer diversification, you may limit your market. So we have a very strong team of real estate agents in the Kitchener-Waterloo-Guelph 401 corridor who are ready to start to move their buyers towards our homes because we offer that diversification. Well, you have to look forward. You have to look years ahead. And it's not just about trying to be net zero so that you can reduce the energy use and produce the energy that you need for your home. And again, with green certification or blue certification. Passive homes, of course, is another term that people are hearing more about. And using 3 triple pane glass for your windows. All kinds of ways to make yourself more efficient. What we're looking at and saying, well, what's a house going to look like in 10 years from now or 20 years from now? And if you don't do this with good partners, with newer technology as far as build technology and construction technology, and if you're not doing it with better materials, you likely can't build at a reasonable price. And that's going to defeat a lot of what we've built into our performance. We want to build at a reasonable price because that captures the widest part of the market. So we have partnered up with builders and construction industry partners who are using more modern technology, and they are looking 10 years out. By design, they're lowering the cost of how much work they do on site in order to achieve an energy efficient home. So when you're doing that, when you're designing and engineering in using newer and better technology, you can incorporate net zero ready or green certification ready or blue certification ready and work towards that. Or you can flip the coin, put a little bit extra cost in if that's what the homeowner wants, and make it fully net zero. So we can manage the costs by managing a better way of development. Well, let's go back to the stack of capital, picture. I think people understand that as every investor comes in. So we're hypothetically going to be open for all 12 months. Investors are putting their money in, so they're piling up their capital and giving it to us. And our privilege is to be able to invest that money into our 5 to 7 properties. Because the durations are different on each project, not every project is going to go to 5 to 7 years. So some of the projects will exit in 18 to 24 months. We have properties that are already ready to be built on. The service lots are sitting there. We can start building as soon as we raise capital. So if you're investor number 1 and you go in on day 1 you're not in a different position. You're pari passu. You're equal to the person who goes in day 20 or day 21, and all that capital that rolls in stacks up. So when we exit any home or any property, that stack of capital we have to return to you. So as we do that, we return the capital back to everybody equally. So as we return all the capital equally, that stack that you've given us goes down. And on top of that, we're going to share the profits on every close in real time. We're not deferring any profits. We're not holding back anything. It's there. It's coming back to you in real time. And what's important to us is that we're proving to our investors that we are aligned with the investor. So as we exit and there's profits, it flows directly through back to the investor. If that's dividends, you get your dividends. If it's business income, you get your business income. If it's just tax preferred, you're getting your tax preferred. And we're doing that in real time as we move through. So I don't think it's likely going to be a scenario where all 5 to 7 properties are held all the way to the end of 5 or 7 years. We will more than likely exit everything within 2.5 to 5 years on the front end of it. Yeah, absolutely. There'll be income flow. We believe in year 2, we'll have solid income flow. There's, as I mentioned, we have 4 properties already under control. And as a good business owners, we know that we need more capital. That's why we're reaching out, looking for more capital. And as we bring that capital in, we can move the capital we have tied up in these properties to the next projects to get them ready to bring into the fund. I can't emphasize more that this is an alignment with investors. They're our partners. So we're sharing the profits. Sure, absolutely. So every project that we look at, so every piece of land that we speculate on, we look at it first and we speculate on our side. We don't expose our investors to that until we believe that the project is meeting all the metrics that we think we need to get to our estimated gross rate of return. So we look for a 50% gross annualized rate of return. So if we can measure and see that a property built out to the finish is going to give us 50% a year of gross return, we know that we can drive a 24% rate of return to our investors.
Okay.
Give or take a few points. So that's the high side. That's the 12 to 24. And if we're going to target all of our properties to exit fully with built out homes, give the keys over to the new homeowners, then we should be hitting that 24% range. If for some reason we identify a property that maybe we can sell off early after site plan approval, so post site plan approval, and we're not quite hitting the top rate, but we feel that it's a strong business case to sell that property, we may only end up getting the 12 to 14% range. So to make sure everybody's understanding, again, we're aligned with the investors, we're transparent with our investors, we want people to know that we're going to be targeting and pushing for those 24% rate of returns, but we're going to give ourselves a buffer that just in case if something changed in the marketplace or in the geographical area where we're investing and we needed to sell off a property for a solid business reason, then that property may only return 12. Yeah, absolutely. We have to be able to look at the property objectively and say, yeah, we've either something's changed in the market or just something materially has changed. We think we have a buyer today that's going to give us X, and that's going to give us a 12% rate of return in the pockets of ourselves, the investors, the fund makes the best decision. We'll go with that. So protect capital first. Well, they're going to want to review our information. I think that's going to be out in your system, so they'll have access to be able to digest all of the information in our PowerPoint and our video that we're providing out there. Assuming that they've got all their answers through there, they'll be able to follow a link that we provide on your portal, on your system, which will take them to a spot where they can initiate an account setup. So it may sound a little foreign to have an online portal to be able to start taking the intake in, but that's the way business is starting to transfer nowadays. It's starting to transition over to an online system. So we'll be there to handhold with people who need some help and some support. But ultimately, it's going to be a few clicks, and they can reserve their spot in the investment. And then as soon as we release each close on the projects, as we bring those 4 projects we have, as we bring them in, the announcement will flow through, I assume, through your systems. And people will know that, oh, we can get in and they can transact and they can say, yeah, I want X number of dollars of this investment. If they feel they want to come back and transact again, they can just go into their account and initiate a second transaction to invest more.
Sounds very efficient. Yeah. Excellent.
Well, we're hoping to be efficient with it. I actually like to pick up on that because it's something we think is, again, transparent and aligned. Spend our time doing what we do, develop properties and drive profit, and not spend as much time maybe on the administrative side of setting up accounts and filling out paperwork.
That makes sense.
So.